Assalamualaikum and salam UiTM di hatiku. In this video, we are going to present on our final year project with the title of Applicability of Value at Risk in Portfolio Optimization for Shari'ah-compliant Stocks. Before I proceed with the presentation, you might have wondered, this is a presentation on analyzing the best stocks portfolio by using mathematical and financial approach. But why do we focus on the Shari'ah-compliant stocks? To answer this question, let's see the motivation and its detailed description.
According to Ayub 1915, there are over 550 Islamic financial institutions around the world and over 75 countries practice Islamic banking and finance to serve the demands, especially from Muslim populations. In the local context, Malaysian Islamic capital market has subsequently shown very encouraging growth in recent years. As the conventional stock doesn't comply with Islamic regulations, Muslim investors cannot engage in the operating of conventional stocks. Islamic finance is based on Shariah compliance regulations that check various factors from religious values. The fundamentals of the regulations are prohibition of riba or interest, gambling and excessive uncertainty. Hence, this is the significance of our studies since most past studies have mostly focused on conventional stocks. By focusing mainly on Shariah compliant organizations, it will benefit investors, especially Muslim investors who are interested in Islamic investments to get a piece of practical information about risk management. Now, next question is arising. What exactly is value at risk and why are we interested about it?
VaR is defined as the maximum expected loss of a portfolio over a specified period with a certain range of certainty under general economic conditions. So, in this study, we aim to fulfill this objective. Now, by looking at our third objective, what is the relationship between VaR and determining the best portfolio? When choosing from a range of efficient portfolios, the best portfolio is the one most preferred by investor. In order to do this, a benchmark called Sharpe ratio is used to evaluate the investment performance of a specified portfolio. However, in this study, we will relate both VaR and portfolio optimization by implementing VaR into the Sharpe ratio formula, and this tool is called as VaR-adjusted Sharpe ratio.
According to Shariah Advisory Council of Bank Negara Malaysia SAC, only 19 companies in the FBMKLCI met the chosen criteria, which are Shariah compliant, and the companies have run their business longer than 5 years. The data to be used in this study is acquired from Icon and Yahoo Finance. Throughout this study, there are several limitations. The first keyword is assumption. All approaches in VaR evaluation only makes an assumption about the current and future return distribution based on historical data or rely directly on historical data. Second keyword is misleading result. If the observation contains unusual volatility, it could lead to misleading results as VaR assumes that the data have constant volatility. This leads to the third keyword, which is catastrophic event. From previous keyword, it also implies that VaR results may be inaccurate as during the 5 years period of our data collection, the outbreak of COVID-19 pandemic happens. The last keyword of our study's limitation is the methodology. This study will mainly use Microsoft Excel and several extension software to evaluate VaR. However, a software used are only available for 15 days trial period.
For background theory and literature review, we focus to discuss on 5 main topics, which are value at risk, RiskMetrics, Bootstrapping Historical Simulation, Monte-Carlo Simulation, and Sharpe ratio. There are numerous researches, journals, and articles that we referred upon understanding the nature of those main topics mentioned. From those references, we extract 4 main information, which are the history of its derivation, definition and theory involved, methodology, and the result of each research provided. By referring to those articles shown, we are able to grasp the idea on how to perform our study and are able to make reasonable justification as it is help to support our finding later. Now, let's move on to the methodology section.
This table refers to 19 Shariah-compliant companies that are listed on the FBMKLCI. The historical data of the closing price were collected from July 2016 until July 2021. The general procedure of this study can be divided into 3 phases. Let's take a look on the first phase, which is the data extraction. This study starts by obtaining 1,256 data of daily closing price. After obtaining the data, the computation of daily returns for every companies and the weighted returns per month is carried out. In this study, we assume that each stock in the portfolio have equal weightage distribution. At the end of the first phase, 61 arrays of portfolio returns is obtained, and this data will be used in the next phase of the procedure.
Generally, for RiskMetrics method, there are two major informations needed to find VaR, which are return portfolio and the standard deviation. Hence, it becomes the early step to execute this method. Return portfolio is obtained by squaring the arrays of weighted returns. Next, to compute the standard deviation, a conditional variance needs to be computed first by using exponentially weighted moving average, where lambda represents the decay factor ranging from 0 to 1. Upon research, it is found that JP Morgan specified that 0.94 was the most applicable decay factor for one-day continuously compounded returns. The data in the array is separated into two blocks where each block consists of 70% and 30% of the observation respectively. The calculation of variance only works with 30% of the observation, and the standard deviation is obtained by simply square rooting the variance. For the last step, VaR is calculated for each observation by multiplying the standard deviation with 1 minus alpha.
Move on to the next methodology, which is the Bootstrapping Historical Simulation. The first step is to compute the daily returns and the weighted return, just like the first step of RiskMetrics. Next, an array of the portfolio return will be resampled or bootstrapped by randomly resampling the dataset 1,000 times, and a bootstrap sample may contain repetition of the same data. The deciding factor on which data should be in a bootstrap sample is by the help of the simulation of generated random numbers. The third step is to evaluate the VaR for every bootstrap dataset by simply finding the 1 minus alpha percentile of the dataset. Last step, after obtaining 1000 VaR values, those values will be added and divided by thousands to find its average VaR for a confidence level, and the procedures will be repeated for the other alpha.
Now, I'm going to explain the last methodology, which is the Monte-Carlo simulation. First, the daily returns of one company is obtained to evaluate the mean and the standard deviation of the company stocks. Next, the drift and the volatility of each company is evaluated, where we took 252 trading days annually into consideration. From the information gathered, the daily closing future price and predicted return is calculated. This simulation will use the computed price for one-time month in the future, where the time delay used is 1 day over 12 months. The future price for each trading day for all 19 companies is evaluated by using geometric random walk model. From this future price, the predicted daily returns is obtained by using the same arithmetic rate of return formula, but the only difference is that the future price is implied into the formula. The fourth step of this method is to find the portfolio return from the previous predicted return by multiplying the returns with the equally distributed weightage. After the data extraction and manipulation is done, it is time to simulate and run the Monte-Carlo simulation using @risk software. The number of iteration and the number of simulation will be set to 1000 and 1 respectively. The last step of this simulation is to plot the histogram with desired confidence interval VaR. To observe the VaR, we will focus on the left tail of the normal distribution, where the value of VaR will be displayed on the software interface.
Now is the last phase of the flowchart, which is the portfolio optimization section. We intended to optimize the portfolio by redistributing the weightage of each stock by using Excel solver according to three portfolios objectives, which are equally distributed weightage, minimizing the standard deviation, and maximizing the portfolio expected return. The formula of Sharpe ratio is given by this. In this study, the government investment issues for Islamic market from the Central Bank of Malaysia official web page is chosen as the risk period with value of 3.55%. After finding the Sharpe ratio for each objective, we will compare the result on which portfolio gives the best value of Sharpe ratio. Since on the second phase of this study, we already find VaR, we intended to implement the best VaR from the best methodologies into the Sharpe ratio by changing its denominator with the value of VaR. This formula now is called as VaR-adjusted Sharpe ratio.
Now, it is time for us to present our results and findings. For the second phase, we want to determine the best VaR evaluation method by comparing the forecasted VaR results with the actual VaR. This graph shows the comparison of each VaR evaluation method with actual VaR at 95%, 98%, and 99% respectively. First, let's analyze the graph behavior. According to the graph, an identical pattern can be observed where the VaR line spiked twice, especially on March 2020 when the peak is very obvious. This scenario happens due to the COVID-19 outbreak that was started to happen on the first quarter of 2020, and on that month also, movement control order was enforced. This resulting in the drastic increment of the daily trading size for all companies. With such potential risk information available, it will trigger the fear of the investors, which may lead them to replan their strategies by reducing their current investments. After analyzing the graph, it is time to determine the best methodologies using MAPE to validate the findings. The summary of the validation are shown as follows. By comparing the percentage error with the MAPE scale, both RiskMetrics and Monte-Carlo Simulation have fall into the highly accurate forecast, whereas only Bootstrapping Historical Simulation fall into good forecast with an average error of 27%. Even though there are two methodologies considered as a highly accurate forecast, only RiskMetrics will be considered into the next phase of portfolio optimization since it offers the lowest error percentage of 7%.
Now, I'm going to explain the findings on the portfolio optimization phase. According to the three objectives mentioned earlier, the weightage distribution for 19 Shari'ah-compliant companies of FBMKLCI is shown as follows. Next, the expected Sharpe ratio for all three portfolios is carried out and the results is shown as follows. Notice that a negative Sharpe ratio is obtained for all portfolios. It means that the portfolio expected return is lesser than the risk-free rate. According to Mohd and Van Vuren, a negative Sharpe ratio brings no valuable information. Hence, a modification of implementation need to be done in order to give meaning even if the excess return turned out to be negative by using probabilistic equivalence approach. This approach will use the normal distribution where the Sharpe ratio obtained need to go through standardizing process to obtain the z-score. This approach is applicable due to the nature of the normal distribution formula, which is similar to the Sharpe ratio. As the probability value approaching to 1, it shows the capability of the portfolio expected return to reach the risk-free rate value in getting a positive value. Hence, the result of the probability is shown as follows. We can see that the highest probability is the portfolio with objective of maximizing portfolio expected return and correspond to the highest Sharpe ratio. Hence, we can say that the objective to maximize portfolio expected return is the best portfolio performance.
In the previous phase, RiskMetrics offered the best VaR and we used the value to be substituted into the denominator of the Sharpe ratio. The results of our findings are shown as follows. By using the VaR-adjusted Sharpe ratio, it is found that the Sharpe ratio resulting to negative value 2. Hence, by adjustment, we observe that the probability of the objective to maximize portfolio expected return also gives the highest probability value regarding any confidence interval. It is found that the result shows consistency with using normal standard deviation. However, the downturn of the findings indicate that the whole portfolio for all three different objectives is underperformed compared with investing in the instrument that has a risk-free rate.
As conclusion, we found that RiskMetrics and Monte-Carlo Simulation are the best VaR evaluation method, in line with the study done by Halkos and Sirivis as well as Maria Bodalova respectively. However, RiskMetrics has shown better error performance compared to Monte-Carlo Simulation, and it is reasonably applicable to achieve the third objective of this study. Through the VaR-adjusted Sharpe ratio, this study able to come out with a best portfolio optimization where Muslim investors are advised to invest in a portfolio that aims to maximize the expected return. In other words, to only invest their principal only to one stock in the portfolio. Even though the downturn of this method shows that the 90 Shari'ah-compliant stocks are underperformed, it still can be expressed through meaningful interpretation that Shariah portfolio with a motivation to maximize the expected return is proficient enough to invest in. There are several recommendations that may be useful for future researchers to take into account. First, VaR methodologies that require historical data should take catastrophic event into consideration during the observing data period, as this kind of unsystematic risk factors affect investor decision to invest in the Sharia stock market. Second, each method presented in this study can be improvised by applying more advanced computing technology to obtain precise and more accurate results. That's all from us. Thank you, and we hope to see you again.